Imagine walking into a quirky little candy shop on a quiet corner of town. The air smells like caramel and childhood. Shelves are lined with brightly colored treats, each one calling out to you. But then you notice something odd. Two identical candy bars, same brand, same flavor, same wrapper. One costs $1, the other, $5. Now here's the real question. Why would anyone pay $5 when the same thing is selling for $1? This is the kind of common sense moment we understand instantly. Of course, we'd choose the cheaper one, right? But Joel Greenblatt says this is exactly what happens every single day on the stock market. Except instead of candy bars, it's businesses. And instead of shelves, it's trading screens. And surprisingly, most people keep grabbing the $5 version without even realizing it. Hey everyone, I'm Bix, and welcome to Bix Book Summary, where we make big ideas simple and bring powerful books to life with stories, clarity, and heart. Today we're diving into the little book that still beats the market. A small book with a massive promise. One that tells you, yes, you can beat the market. And no, it doesn't require genius, insider tips, or high-frequency trading bots. This isn't just another investment guide full of jargon. Greenblatt, who's a hedge fund legend by the way, breaks down his method like he's teaching it to his own kids, which he literally was. He strips it back to basics, using gumball machines, candy shops, and plain logic to help us see investing not as gambling, but as buying good businesses at good prices. That's the core of what he calls the magic formula. And once you understand it, you'll never look at investing the same way again. Think of the magic formula like walking into that candy store again. But this time, you've got a secret list. It tells you which candy bars are the best tasting and the best deals. All you have to do is pick the top ones and leave the overpriced ones behind. That's what Greenblatt's strategy does for stocks. It ranks businesses based on two simple criteria: how profitable they are and how cheap their stock is compared to that profit. That's it. No crystal balls, no fancy forecasts, just logic and discipline. And what's wild is this approach, despite being so simple, has outperformed most professional investors, year after year, decade after decade. In fact, when Greenblatt tested it over a long period, it beat the market by a wide margin. Not because it's flashy or fast, but because it's grounded in something we all understand. Don't overpay and buy quality. In this video, I'll walk you through that formula step by step. What it means, how it works, and why it's so effective, even a 13-year-old could follow it. We'll explore how the stock market really works, why most investors underperform, and how a simple shift in how you pick stocks can put you years ahead financially. And I'll share stories from the book that make it all come to life, including how Greenblatt explains complex ideas using snack machines, silly names, and real-world examples that stick. So whether you're just starting your investing journey or want to take back control from confusing financial advice, this book and this summary is your guide. You don't need to be rich to start. You just need the right mindset and a bit of patience. And once you see the market through this lens, you'll realize it's not a chaotic casino. It's a giant candy shop. And now, you've got the map. Let's get started. Joel Greenblatt doesn't open his book with charts or numbers or market history. He starts with something far more powerful. A story so simple it slips right under your defenses. He asks us to picture a gumball machine. Nothing fancy, just one of those small machines that sits near the counter of an old shop, humming along quietly, taking quarters and dispensing candy. Now, imagine that this little machine earns $1,000 a year in profit after all expenses are paid. Gum, maintenance, electricity, everything. A clean $1,000, year in and year out. Now picture this. Someone offers to sell you that machine for $1,000. 1 year of profits gets you your full investment back. That's 100% return in 1 year. Sounds like a dream deal, right? But here's where it gets interesting. Imagine someone else comes along and offers you the same machine. No upgrades, no improvements, just another identical one for $10,000. Nothing changes except the price. Now it would take you 10 full years just to earn back your investment. Suddenly, it's not such a great deal. In fact, it sounds a little ridiculous, doesn't it? And yet, this is exactly what people do on the stock market every single day. They buy pieces of businesses without knowing what those businesses actually earn. They get caught up in excitement, in momentum, in fear of missing out. They chase rising prices and ignore the fundamentals. And in the process, they end up paying $10,000 for a $1,000 machine. Greenblatt's brilliance lies in how clearly he cuts through the noise. A stock, he reminds us, isn't just a ticker bouncing on a screen. It's not a lottery ticket or a bet. It's a share of a real business. And if we can just remember that simple truth, that a stock is a piece of a business, and its value depends on how much money that business makes, then suddenly everything starts to make more sense. That's the foundational shift. That's where he starts changing the way we think. Most investors, Greenblatt says, act like speculators. They try to guess what will happen next, but smart investors, they act like business owners. They don't chase prices. They look for value. They don't need to be right today. They're willing to wait for the right opportunity to come along. And this is where the idea of the magic formula starts to take shape. The formula itself is based on two simple principles. How well a business earns money using the capital it has, something called return on capital, and how cheap the stock is compared to those earnings, known as earnings yield. These two numbers give us a lens through which we can find businesses that are both profitable and undervalued. The candy shop bargains, the $1,000 machines selling for less than they're worth. But before we dive into how the formula works, we need to sit with this gumball story a little longer. Because it's not just a metaphor, it's a mental reset. A reminder that investing isn't about complexity, it's about clarity. It's about knowing what you're buying, understanding what it's worth, and refusing to overpay just because others are. So now that we've stepped into the shoes of a business owner, and we're starting to see the market through a more rational, grounded lens, let's talk about what usually goes wrong. Why, despite all this common sense, do most investors still underperform? And what role does emotion play in that painful underperformance? Let's unpack that next. Here's the part most people don't want to hear. But Joel Greenblatt doesn't sugarcoat it. He puts it right out there early in the book. The average investor, whether they're managing their own money or running a professional fund, usually underperforms the market. That's not just a casual observation. It's backed by decades of data. Even with all the tools in the world, fancy spreadsheets, trading apps, degrees from Ivy League schools, the results still lag behind what you'd get if you just bought an index fund and left it alone. So why does this happen? Greenblatt narrows it down to one powerful word: emotion. The stock market is a reflection of human psychology on full display. It behaves like a living organism, constantly reacting to news, rumors, earnings reports, and global events. But beneath the noise, beneath all the excitement and panic, are real businesses quietly doing what they do. Selling products, generating profits, serving customers. The market's short-term mood swings have little to do with how these businesses are actually performing. And yet, those mood swings are what most investors respond to. When stocks drop, fear kicks in. People sell. When stocks surge, greed takes over. People buy. It's backward. Imagine walking into a store and seeing your favorite shoes marked down 50 cents. You'd celebrate. But when great companies go on sale in the market, most investors run the other way. Why? Because it feels risky. It feels wrong. And that emotional discomfort causes people to abandon logic. Greenblatt points out that our instincts are wired for survival, not long-term investing. We're programmed to avoid pain and seek pleasure. So when the market dips and our portfolio turns red, our brains scream, "Get out!" And when everything's green and rising, we feel safe and want more. But investing rewards those who can go against that impulse. This is why value investing is so hard. Even though it sounds easy, you're asked to buy when everyone else is selling, to stay calm when the media is shouting doom, to trust a method even when it doesn't seem to be working in the short term. And that's exactly where most people fail. Not because the strategy is flawed, but because they bail out too early. And here's the crucial insight. Just because something doesn't work instantly doesn't mean it doesn't work. The magic formula Greenblatt developed based on real business principles has been tested and retested. It doesn't promise instant success. In fact, it sometimes underperforms for months, even years. But over the long haul, it wins. Not because it's complex, but because it's rooted in buying good businesses at good prices and letting time do its job. What Greenblatt is really saying here is that your biggest enemy isn't the market, it's your own reactions to it. If you can learn to step back, to trust the process, and to stick with it when it's uncomfortable, that's where the real edge lies. You don't need to outsmart Wall Street, you just need to outlast your own emotions. And that's why he created the magic formula, not just to find good stocks, but to give people a system that protects them from themselves. A method that removes the drama and the guesswork, that allows you to invest with logic instead of fear or greed. So now that we've seen how emotion is the downfall of most investors, and how the right system can shift the odds in your favor, it's time to dive into that system. Let's break down the magic formula, how it works, what it looks for, and why it continues to beat the market year after year if you just stick with it. At this point, Joel Greenblatt does something really clever. After carefully laying out how emotions sabotage even the smartest investors, he doesn't just say be less emotional. He gives you a tool that makes emotion irrelevant. He introduces the magic formula. Now, don't let the name fool you. It's not mystical. It doesn't involve secret codes or market timing tricks. It's magic because of how simple it is and how powerfully it works when followed properly. The magic formula is built on just two basic but powerful ideas: how good a business is and how cheap it is to buy. That's it. No charts, no forecasts, no guesswork, just two clear metrics. So let's break that down in plain terms. The first part is measuring how good a business is. Greenblatt uses something called return on capital, or ROC. Think of this like the efficiency score of a business, how well it turns its investment into profit. Imagine you open a small bakery. You invest $1,000 into it, buying ingredients, equipment, paying rent, and by the end of the year, you've made $300 in profit. That's a 30% return on capital. That's good. It means you're not just working hard, you're working smart. The higher the return on capital, the more efficient and profitable the business tends to be. The second part is all about price. And for that, he uses earnings yield. This is kind of the inverse of the PE ratio, but it tells you something really important: how much you're earning for every dollar you invest. If a company earns $10 per share and the stock trades at $100, that's a 10% earnings yield. Higher is better because it means you're getting more income for every dollar you spend buying the stock. Now here's where the formula gets interesting. Greenblatt takes every company in the market and ranks them. One list based on how good the business is, return on capital, and one based on how cheap the stock is, earnings yield. Then he combines the two rankings to find the companies that are both high quality and undervalued. These are the sweet spots, companies that are running well and being sold at a discount. It's like finding premium sneakers on a clearance rack. Greenblatt explains all this in a way that even kids can get. Picture going to the farmer's market to pick apples. Some are fresh, shiny, and juicy. Others are bruised. You want the good ones, right? But you don't want to overpay either. You're looking for the best apples at the best price. That's what the magic formula does. It keeps you focused on quality and price, and ignores the noise that distracts most investors. What's really compelling is how this simple system performs. When tested over many years and across various market cycles, it consistently beats the broader market. Not just a little, but often by a meaningful margin. In fact, it outperforms not only most individual investors, but many high-paid fund managers with teams of analysts behind them. Why? Because it's consistent, because it's emotionless, and because it sticks to business basics. But, and this is important, it's not always smooth. There are stretches where the strategy doesn't look like it's working. Months where you're holding on to these great deals while the market seems to be flying in a different direction. That's when most people lose their nerve and give up. And that's exactly why most people don't see the results. Because even with a great system, discipline is everything. That's what Greenblatt wants us to understand. Success doesn't come from excitement or quick wins. It comes from sticking with a system that works, even when it feels boring, even when your neighbor is bragging about some hot new stock. Because over time, boring and disciplined beats flashy and frantic. So if the formula is this clear and powerful, how do you actually use it? In the next part, we'll walk through how Greenblatt applies the magic formula in real life. What steps to take, how often to invest, what to avoid, and how you can start using it no matter where you are in your financial journey. So now that we've wrapped our heads around the logic behind the magic formula, buying great companies at good prices, the natural next question is, how do we actually use it? Joel Greenblatt doesn't just hand you the theory and leave you on your own. He lays out a remarkably clear, step-by-step plan. And the beauty is, it's designed for everyone. Whether you've never bought a stock in your life or you've been dabbling for years, this strategy is meant to be simple, practical, and doable. Here's how it works in real life. First, you begin by narrowing your field. You're not trying to sort through every company in the world. Greenblatt suggests focusing on the largest US companies that meet some basic filters. You exclude financial institutions like banks and insurance companies because their balance sheets can be a bit tricky, and you skip utilities for similar reasons. You also avoid companies that are too small or not traded frequently enough. The idea is to stick with businesses that are stable, transparent, and easy to buy and sell. Next comes the magic part. You use publicly available data, things you can find on most financial websites or stock screeners, and rank these companies based on two things: return on capital and earnings yield. Return on capital tells you how well the company is turning its resources into profit. It's a measure of quality. Earnings yield tells you how cheap the stock is relative to those profits. It's a measure of price. You rank every company on both factors, then add the rankings together. The ones with the best combined scores, those that rank high in both quality and value, become your top picks. That's your magic formula list. Now here's where discipline comes in. Greenblatt recommends building a portfolio of 20 to 30 of these companies. But you don't buy them all at once. Instead, you spread your purchases over the course of a year, maybe 5 to 7 stocks every few months. This helps you avoid putting all your money into the market at one specific moment and smooths out the ups and downs. You hold each stock for about 1 year, give or take a few days for tax efficiency, and then you refresh your list. Sell the ones that drop off and replace them with new top-ranked names from the latest formula results. And here's the part that trips up most people. Once you've picked the stocks, you don't interfere. You don't skip a pick because the news sounds scary. You don't sell early because one of your stocks drops suddenly. You don't override the formula based on gut feeling. That's the whole point. The formula is designed to remove emotion, not accommodate it. Greenblatt stresses this over and over. You have to stay the course, even when it's uncomfortable, especially when it's uncomfortable. Because yes, there will be times when the strategy underperforms. There will be months or even years when it looks like it's not working. And that's when most people give up. But those who stick with it, Greenblatt says, are the ones who see the payoff. Over time, the formula beats the market. Not with flash, not with speed, but with quiet, consistent discipline. And perhaps the most beautiful thing about it is how grounded it is in common sense. Greenblatt originally created this method not for Wall Street pros, but for his own kids. That's how straightforward it is. This isn't about trading. It's about buying good businesses the same way you might buy a rental property or a small shop. It's about shifting your mindset from gambling to owning, from reacting to thinking long-term. In the final part of the book, Greenblatt leaves us with a reflection that goes far beyond money. He reminds us that this strategy isn't just a formula for wealth. It's a formula for life. It's about patience. It's about clarity. It's about making good decisions, even when it's hard, and trusting that over time, those choices will compound into something meaningful. So if you're tired of the noise, the stress, the constant market roller coaster, maybe it's time to try something quieter, smarter, simpler, something that still beats the market. Joel Greenblatt closes The Little Book That Still Beats the Market, not with a flashy finale, but with something much more valuable, a quiet, grounded truth that extends far beyond investing. Yes, the magic formula works. Yes, it consistently outperforms many seasoned professionals. But Greenblatt's real message? Success doesn't belong to the fastest thinker or the cleverest analyst. It belongs to the one who can stay steady. Because the real battlefield isn't out there in the market, it's inside us. Most people don't lose money because they can't do the math. They lose because they can't manage their fear, their impatience, their need to do something when doing nothing would have been wiser. They see the market dip and their stomach turns. They see someone else getting rich on a trend and they jump in late. It's not logic that fails us. It's emotion. And that's why the magic formula matters. It's not exciting. It doesn't promise you fast cars or viral wins. It's not going to make headlines. But its quiet power lies in its simplicity, in its discipline. It works precisely because it doesn't change when the world gets noisy. And if you can follow it, if you can really stick with it, it gives you something most investors never have, a true edge. But this book, it's not just about stocks. It's about how to think clearly when the world tempts you to act irrationally. It's about the courage to follow a strategy when everyone around you is chasing something shinier. And most importantly, it's about long-term trust in the process, in the numbers, in yourself. What makes this message even more special is knowing that Greenblatt wrote this book for his kids. He wasn't selling a course or building a brand. He was passing on a blueprint, something simple enough for a teenager, but powerful enough for anyone. This isn't a hedge fund playbook. It's a life lesson disguised as a financial strategy. So if you've ever felt overwhelmed by investing or doubted whether you have what it takes to succeed with money, let this book reassure you. You do. You don't need to predict the future or time the market. You just need to remember a few timeless truths. Buy good businesses. Buy them at good prices. Stick with your plan. And don't let your emotions take the wheel. If this summary helped shift the way you think, even just a little, please like, comment, and subscribe to Bix Book Summary. This is where we turn powerful books into practical, soulful journeys that stay with you long after the video ends. And if this little book sparked something in you, the link to grab your own copy of the little book that still beats the market is down below. It's short, it's clear, and it might just change how you see investing forever. Let me know in the comments what's one mindset shift you're taking away from this book. Until next time, stay steady, stay focused, and keep building the life you deserve. One clear decision at a time.